So, at Abaxx, we're launching the first regulated commodity clearinghouse really since the Dodd-Frank regulations more than a decade ago. And we really focused on three areas that are, the growth commodities headed into this energy transition. So global natural gas and through liquefied natural gas, LNG markets, battery metals, and then environmental markets like global carbon credits. And really the metals in particular are going through such an interesting time because obviously we've had a lot of crosswinds and a lot of sort of general bearishness in the near term because of Chinese housing. But if you look out over the next 5-10 years, the demand growth is massive from EVs. So we really need, in our view, a number of new market infrastructure and benchmarks for the capitalization of this demand growth.
In terms of the products that we're talking about here that would be part of a futures contract on the exchange, some of them might be found in places like China. And we're just talking about the restrictions, for instance. Yeah. A lot of the components that are going into EV batteries are really sourced in that country and also beyond, places that are slightly less accessible for investors these days. Yeah. How does that manifest itself in terms of pricing for the exchange and access here?
That is actually one of the major challenges, right, is we're seeing this sort of balkanization of supply chains. And particularly when you look at commodity prices, both the supply and demand for a lot of these industrial minerals is coming from inside of China on the supply and demand growth, and yet in Asia in general, and yet a lot of our financial markets for hedging happens in London or New York, and so we have this separation from the physical markets and the financial markets, which is of course exactly where we had one of the big problems with the London Metals Exchange and the nickel market last year. So what we're doing is launching a futures exchange in Singapore that really probably bridges these markets a little bit better than our current situation.
Well, sorry, just let's go back a stage, Josh, because, I mean, you've covered a lot of ground with Karen already. Why increasing the pool of financial investors, long and short, into these commodities? Why is that better than actually leaving it to the industrial players? There are great examples of financial investors, and you just mentioned one there with the LME as well, right, of how there is a distortion rather than a price discovery process. There is a distortion of that price discovery process because of the interventions of financial players rather than industry players.
Well, I think the problem that we have in commodity markets is your producers are always looking to sell and manage their risk, right? Because they're very much exposed to that top line price risk. But the problem is you don't always have a lot of demand, with buying 4 or 5 years out into the future. So naturally we need speculators in these markets to form that price discovery and lay off that price risk for producers. But increasingly we see a lot of the trading kind of really in the front months and not in the long-term futures.
So let's go back to a primary point that's been raised ever since the Dutch started doing this, 500 years ago, with some form of agricultural exchange as well. Because as a former derivatives guy myself as well, I know full well that there is an underlying price and very often there is a distortion of that price. Are you saying actually that by adding more financial players there won't be a distortion of price? Categorically, you can say that.
Yeah, I would say over the medium term, absolutely, because you need that risk management for the producers to lay off that risk, and that's really where that financial liquidity becomes so important.
And then the third class of investor get involved. Again, we've talked about industrial, we've talked about the senior financial players as well. You're encouraging, and again, I'm not here to criticise the product because I believe in derivative products on products because I think that they help by and large. But you are encouraging tourists into these areas where they know absolutely nothing about the fundamentals of lithium, cobalt, nickel, what have you as well. So you're encouraging tourists, and one thing I do know is that when you encourage tourists in commodity markets as well, they're normally on a hiding to nothing.
Yeah, well, look, I think that's where the rules of the exchange and the operation of the exchange is so important, right? Like it's our job to help build the rules for managing this risk. And actually one of the big problems in the battery metals, for example, right now, is there's not physical delivery products. Currently the products that we've seen out of some of the other exchanges are based on surveys, right? So that they're not actually touching the supply and demand and the physical delivery of the products, which is exactly the approach that we're taking that's a bit different than the existing exchanges.